All right, let's just put it out there. When most people hear the words mutual fund, they just tense up, right? It's like this mental wall goes up. They think it's incredibly complicated, or maybe it's just a fancy word for gambling, or something that's reserved exclusively for Wall Street finance experts. And because of that very real fear of losing hard earned money, a lot of folks simply avoid investing altogether. But here is the absolute truth. Almost every single successful long term investor has used mutual funds at some point to build their wealth. It's a foundational tool. So, welcome to This Explainer. Today, we are going to completely demystify mutual funds. I mean it. Even if you have literally never invested a single rupee before, by the time we wrap this up, you are going to understand exactly how they work and exactly how to use them to your massive advantage. So, here's our roadmap for This Explainer. We're going to cover 1, what a mutual fund actually is, 2, essential mutual fund terms, 3, the direct plan wealth hack, 4, your mutual fund family tree, 5, how a SIP actually works, and finally, 6, the exact steps you can take to start investing right now. Okay, part 1. What is a mutual fund? Imagine this scenario for a second. Let's say someone drops 10 crore rupees in your lap right now and says, invest this wisely. Honestly, most of us wouldn't even have a clue where to begin. I mean, which companies do you buy? How do you manage the risk of losing it all? It's overwhelming. Well, let's flip it. Imagine 10,000 everyday people, just like you and me, each deciding to invest 10,000 rupees. All that money is collected or pooled together, giving us that massive 10 crore rupee fund. And this right here brilliantly illustrates the entire core concept of a mutual fund. It's literally just a giant pool of money. It's simple, it's highly democratic, and it is extraordinarily powerful. So how does your money actually flow through the system? Well, it starts with you investing your money, which is then pooled together with thousands of other investors. But this massive pool doesn't just sit there in a bank account. It's handed over to a full-time professional known as a fund manager. Their literal day job is to take that giant pool of money and strategically spread it out across dozens, sometimes hundreds of different investments in the market. You can think of it like that classic eggs in a basket analogy, right? By spreading the money around to different companies and sectors, the fund manager diversifies the investments. And that significantly reduces your overall risk. You're not relying on just one company to succeed. Then, when that overall market portfolio grows over time, those returns flow right back down to you. Moving right along to part 2, essential mutual fund terms. Let's do some quick jargon busting. The very first term you're going to see absolutely everywhere is NAV. That stands for net asset value. But let's keep it simple. Think of a mutual fund like a giant pizza that you are sharing with thousands of friends. The NAV is simply the price of your individual slice of that mutual fund pie. That's it. So, if the NAV is 120 rupees and you decide to invest 12,000 rupees, you are buying exactly 100 slices or units of that fund. And this price isn't changing every single second like a stock. It is calculated just once a day, right after the market closes. Next up is AUM, which stands for Assets Under Management. This is a fancy way of saying the total amount of money that the mutual fund is managing. If a fund has an AUM of 30,000 crore rupees, it basically means a whole lot of people trust them with a whole lot of money. But, and this is a big but, keep in mind that while a large AUM means the fund is established and popular, it doesn't automatically guarantee you higher returns. It's really just a measure of the fund's size, not its future performance. Now, I really need you to pay close attention to this next one, because this silently affects your money every single day. The expense ratio. Managing a huge fund isn't free, right? You have to pay the professionals, the analysts, the operational costs. The expense ratio is simply the annual fee charged by the fund to cover all those costs. But here is the absolutely crucial thing to remember. This fee is deducted automatically from your NAV. You are never going to get a bill in the mail for it. It just vanishes from your returns in the background. And that is exactly why hunting for a lower expense ratio is totally vital for your long-term wealth. Every fraction of a percent matters. Which brings us perfectly to part 3, the direct plan wealth hack. Okay, this is a game changer. Almost every single mutual fund in India comes in 2 identical versions, the regular plan and the direct plan. They are literally the same fund. They have the exact same portfolio of stocks and they're run by the exact same fund manager. The only difference is who you buy it through. See, if you buy a regular plan through your bank or a traditional distributor, a hidden commission of roughly 0.5 to 1.5% is paid out to that middleman every single year, and that money comes straight out of your investment. But if you choose the direct plan, which means buying directly from the asset management company or using a zero commission platform, there is no middleman, period. That means 0 hidden commissions and a much lower expense ratio for you. You might be thinking, well, it's just 1%, who cares? Look at this number, 6,70,000 rupees. Let me break down what that tiny 1% difference actually looks like over time. If you invest 5,000 rupees every single month for 20 years in a regular plan, your final corpus might grow to about 46.2 lakh rupees. Not bad, right? But wait, that exact same investment in the exact same fund, but in a direct plan, would grow to 52.9 lakh rupees. That is nearly 6.7 lakh rupees completely lost to commissions simply because you clicked regular instead of direct. Always, always choose the direct plan. It's a total no-brainer. All right, section 4, your mutual fund family tree. Let's map this out. The easiest way to think of the mutual fund universe is like a big tree with 3 main branches. First up, we have equity funds. These invest directly in company stocks. They are your ultimate growth engine. Yes, they carry higher risk in the short term, but historically, they generate the highest returns. You want to use these for long-term goals that are 7 or more years away. Second, we have debt funds. These invest in things like bonds and government securities. This is your stability engine. It's not going to make you wildly rich, but it's perfect for parking money for short-term goals of 1 to 3 years. And finally, the third branch, hybrid funds. Just like the name implies, these mix both equity and debt together. They offer a middle path for folks who want decent, balanced growth, but maybe don't want to ride the full roller coaster of the stock market. They're great for a 3 to 5 year horizon. Now, if we zoom in on that equity branch, you have a massive fundamental choice to make: active funds versus index funds. Active funds rely on a highly paid human fund manager and a whole team of analysts who are actively trying to pick the absolute best stocks to beat the market average. Index funds, on the other hand, they don't even try to beat the market. They just cheaply, simply, and automatically copy a market index, like the Nifty 50. And here is a wild, globally proven truth. Over a 10 to 15-year period, simply copying the market cheaply through an index fund very often actually beats those expensive human stock pickers. It's boring, but it is incredibly effective. Section 5, how a SIP actually works. Listen, so many people get this completely wrong. They think a SIP, a systematic investment plan, is a specific type of mutual fund. It's not. A SIP is literally just an automatic instruction you give to your bank. You are just saying to the system, hey, every month on the 5th, take 5,000 rupees out of my account and go buy units of this specific mutual fund. That's the whole shebang. There is absolutely no underlying magic in the SIP instruction itself. All the magic, the real wealth-building power, comes from your absolute consistency and the immense power of time. I really want the math on this to just sink in for a second because it blew my mind the first time I saw it. If you set up a SIP for 5,000 rupees a month and you just let it run for 30 years at an estimated 12% return, your total invested amount, the actual cash out of your pocket, is 18 lakh rupees. But your estimated final corpus? 1.76 crore rupees. Think about that for a second. You put in 18 lakh and the market did 1.58 crore of the heavy lifting for you. It's like having an army of money working for you while you sleep. That is what relentless consistency does. And this is why starting early is everything. Time is literally your greatest asset here, far more powerful than the amount of money you have. Look at this comparison. If you start investing 5,000 rupees a month at age 22, you are going to end up with vastly more money by age 60 than someone who waits and starts 10 years later at age 32. And get this, that's true even if that 32-year-old panics and invests double the amount, 10,000 rupees a month. 10 years of delay simply cannot be compensated for by doubling your investment later. Time is doing the compounding. You can't get those years back. Now, if you want the absolute ultimate wealth hack, this is it right here. The Step Up SIP. Most people set up a 5,000 rupee SIP, they forget about it for 20 years, and they end up with a very respectable 49.9 lakh rupees. But as you get older, your salary usually grows, right? Your investments should definitely grow too. If you just instruct your investment platform to automatically increase your SIP amount by a mere 10% every year, so next year it's 5,500, then 6,050, that exact same starting investment rockets up to a massive corpus of 1.19 crore over 20 years. Seriously, just a tiny 10% annual bump literally more than doubles your final wealth. It's incredible. All right, final section, Section 6. Steps to start investing now. Here is your highly practical, no excuses checklist. It really is this straightforward. Step 1. Complete your KYC online. It takes maybe 15 minutes max using your PAN and Aadhaar. Step 2. Choose a zero-commission investment platform.
Things like Zerodha Coin, Grow, or MF Central are all great options. Step 3, select your fund, and I cannot stress this enough. Make absolutely sure you toggle or click that crucial direct plan mode. Do not pay those hidden fees. And step 4, set up your SIP auto debit. A pro tip here, set it for around the 5th of the month. That way, your investing happens automatically before you even have a chance to spend your salary. As you begin this journey, I want you to keep these golden rules printed in your mind. Start as early as humanly possible. Always, always choose direct plans. Increase your SIP annually as your income grows. Invest with a clear goal in mind so you stay motivated. And perhaps most importantly, never ever panic during market crashes. Stopping your SIP during a market crash is quite literally the worst mistake you can make. Why? Because you are stopping exactly when the market is down and mutual fund units are basically on sale. Panicking and pulling out turns a temporary market drop into a permanent personal loss. Don't do it.
I want to share this incredibly grounding quote from the legendary investor Warren Buffett. He says, "The stock market is a device for transferring money from the impatient to the patient." And he hit the nail on the head. Successful investing isn't about having perfect timing. It isn't about picking some ultimate magic fund that beats everyone else. And it certainly isn't about getting rich quick. It is about immense, unwavering patience. So, I want to end this explainer with a real challenge for you. Stop waiting for the perfect moment, because it doesn't exist. Ask yourself right now, what is your primary financial goal? Are you aiming for an early retirement, buying a dream home, or maybe just achieving total financial freedom? And much more importantly, what is the single concrete step you are going to take today to start compounding your wealth? Please don't let another year just slip by. Do the KYC, pick a direct index fund, set up that SIP, and finally let time become your biggest, most powerful wealth building partner. Thanks so much for joining me on this explainer, and happy investing.